All right, well, hello there, everyone. Hopefully you're doing outstanding. Today is Monday, August the 1st, year 2022. Man, time does fly. Anyway, we have another special guest with us today, somebody you've come to know from both my channel and his channel. So anyway, Millennial Mike, how are you doing today, buddy?
I'm doing good, man. Happy to talk about today's topic, what we're going to talk about is the recession, the crash, what's going on. So we have officially had 2 quarters of GDP contraction. And throughout most of history, as you were telling me before we started, you took an economics class back in the day where you learned that 2 quarters of economic GDP contraction is a recession. However, it's not being officially called a recession for some minor or some more minute details that most people aren't familiar with. One of the things is that in order for it to officially be called a recession, there has to be a drop in unemployment. That's not what we're seeing. And so that's why certain news outlets and political parties are saying, oh, it's not actually a recession. But the fact of the matter remains that we have experienced 2 quarters of GDP contraction, which historically most people have associated with a recession. But what we wanted to talk about today is, okay, it's a recession. Does it feel like a recession to you? When you're going to work, what's different about this recession than the Great Recession, the most recent one other than the flash crash, the most recent one in recent times that we can remember? So Mark, what do you think?
Okay, well, from my perspective, and I'm different than a lot of people because I'm no longer working a job, but from my perspective, I'm not feeling a recession like I have in the past because I have lived and worked through numerous recessions, including the Great Recession. I believe it was a recession during the dot-com crash. I'm positive it was a recession then. But what I'm seeing now, like I'm not seeing, as an example, my neighbors losing their job. I'm not seeing unemployment going up. So as of yet, by definition, as you said, according to what I studied as a business major, we meet the clinical definition of a recession, 2 negative quarters of growth. But it's very minor, but I'm not seeing the impact of that, at least where I'm at. It hasn't affected any of my tenants losing their job that I know of. It hasn't affected my siblings who work jobs. So from my perspective, we're still chugging along okay.
Yeah, and so what I think is interesting is everybody will agree that the economy is struggling right now, but not in the way that a recession makes the economy struggle. We're experiencing inflation at unprecedented rates, right? When you go to pump gas, it's way more expensive than it was 2 years ago. It's pretty much double from what it was 2 years ago. I mean, I routinely pay $5.50 a gallon out here in Washington. The cost of food is going up. The cost, as you were just talking about, you canceled the trip to Oklahoma because the airline ticket was ridiculously expensive. The cost of everything is going up through the roof, but that's different than how a recession feels. And what I think the main difference is about a recession, and if I remember back to when I was 16, 17, when the last one was kicking off, I constantly heard people talking about so-and-so lost his job. Somebody from church just lost their job. The neighbor down the street lost his job. Your parents or you might have lost your job. And there's that quote that says, a recession's when your neighbor loses a job, a depression's when you lose your job. But I think, and maybe this is why why it's an important technical part of the definition of recession. It doesn't really feel like it until you start to feel that fear and anxiety of, oh, people are actually losing their jobs. And of course, last time that translated into, and now they're losing their houses.
Right, very, very true. Because last time when it started, I was a stock investor and I was working as a police officer. And I can't remember exactly how it felt when it started, but I know it dropped. And you pulled this up just recently before we started recording. It dropped much more that first quarter than it dropped for us now. But as it started progressing, I saw visual changes in society, not just with people losing their job, I also saw the city I worked for. I saw their numbers. Their tax revenue dropped off a lot. While their tax revenue dropped off, budgets got cut for the police, the fire, teachers, et cetera, et cetera. I saw grass that would normally be cut alongside of highways was getting knee high, waist high, because the cities were not cutting that grass. And I saw foreclosure after foreclosure after foreclosure all around where I was. And I was in a very small market area that wasn't impacted much by the housing crash compared to the bigger areas. And yet there were still more foreclosures during that several year period back then than there has been in memory before or ever since. And right now, from my perspective, what we're starting to see is the crazy rise, crazy increase in housing prices has seemed to cool off. It's stabilized. Locally where I'm at, sellers were putting houses on the market and bump them up higher. And now they're cutting the prices 5, 10, 12%, which is a more reasonable price because they were just trying to get every penny they could. And from talking to local real estate agents for this part of Florida, they all say the same thing. They see housing prices stabilizing about where they're at now and returning to normal appreciation of 3, 4 to 5%. But they are not seeing a price pullback on houses. And from what I hear around the country, a lot of folks around the country are saying the same thing. Due to the housing shortage, the housing demand, yes, prices will cool off that 50 to 100% gain that they've been having, but they're not gonna drop like we did back in 2008, 2009, 2010.
Mm. Yeah, prices are still in most markets that I'm looking at, like here in Seattle or when I look at Gary, Indiana, when I talk to other people. If you look at prices today compared to 2 years ago, we're way up. If you look at prices today compared to 1 year ago, we're way up. If you look at prices today versus 3 months ago before interest rates skyrocketed, maybe as compared to 3 months ago, prices have come down a small amount. But ultimately, I don't think that's going to lead to a major crash in prices. Our year-over-year statistics still show that we're up in the value of homes. It's just people were continuing to ask for more and more. And when interest rates went up, doubled, that cut the ability for people to make 52 offers on a house in 1 weekend. As we see, and we heard the stories over the last couple of years. People put their house on, they'd have 52 offers over a weekend, 25 cash offers, all contingencies gone. Just ridiculous, and that's gone away. But when it comes to, okay, well, then this means prices are going to crash, prices are going to fall. No, it doesn't. In fact, in the 1970s, during the Carter administration, interest rates hit an all-time high of 18%. 18% was what the Fed funds rate was set to. And prices for housing never went down. Prices for housing have never gone down except for 2007, 2008, 2009. And that was not because interest rates were going up. That's because there was a major economic recession, and it was a real estate-led recession. But interest rates fell at that time and housing prices continued to fall. So we have historical precedent that rates can go as high as 18% and housing prices can continue to rise. Transactions cooled off, the housing market slowed, but the values didn't crash. And why? Well, as back then in the 70s, high inflation, but there wasn't high unemployment. People do not become forced sellers unless they lose their job. If you think about it, are you going to sell your house at a loss unless you absolutely have to? And the only reason you would absolutely have to is if you've lost your job and you're facing the threat of a foreclosure. And so your best option is to sell it to keep your equity, maybe even sell it at a decrease or a loss just to try to get rid of it so you don't lose all your equity and have to file bankruptcy. But unless that happens, people aren't going to sell at a loss. They're just going to hold back and wait. All right, well, we'll just wait for interest rates to come back down so people can afford the price that I want to sell my house for. That's what happened in the 70s. That's what's going to happen now. And that's why I think it feels different today than it did in 2007, 2008. Without unemployment going in the stat that I pulled up earlier for you, so unemployment went from 4.5% and peaked at 10% in 2009. 10%. Right now, we're in the threes. So unemployment would have to triple to get back to where it was in 2007, 8, and 9. And if it doesn't, there's no urgency in the economy and there's no urgency in the recession because no one is being forced to sell. and there's not millions of people losing their jobs, unable to participate in the economy. And then just for the record, our Q1 contraction this year was a negative 1.4%. Our Q2 contraction was a negative 0.9%. Now, to put that into perspective for you, 2007, the GDP contracted by 4.3%. So, 4 times what it contracted by this quarter it did back then. So that's why we're not feeling it as much. That combined with the fact that we're just not experiencing the unemployment. Now, that doesn't mean things can't change. So my final question to you, Mark, is do you think we're kind of hovering here with this very mild recession, or are things going to get worse?
That's a trick question, Mike. Because first of all, you and I both, we are not experts on anything in regards to the economy.
True.
So whatever I say, it's just a guess, basically, or a feeling. But from how I feel and from what I see, I think in the short term, the next year, 2 years, 3 years, we're going to see kind of slowing growth like we're seeing now. I don't think we're going to see a sharp recession. I don't think we're going to see growth take off and shoot back up. I think we're just going to kind of like flatline for the next year, 18 months, 2 years, maybe 3 years. And we'll kind of just see how it all plays out. But since this is an investing channel, I think it's a great time, as always, to find great deals. It was a great time a year ago. It's a great time now. It'll be a great time in 12, 18, 24, 36 months. There's always deals out there, but as investors, we have to find them. But one thing has happened to impact me that may impact others, the banking industry may get a little paranoid. And my non-QM lender is displaying this because in the middle of me doing everything, they changed their rules, and it's complicating things for my situation. But if they don't keep changing the rules, it's no big deal. We adjust to the new rules and life goes on. But if all the banks start changing the rules and increasing their standards, it will impact some investors out there. Not the majority of investors, but it will impact some investors.
Yeah, I agree. I think that if you are the type of person who likes to do BRRRR projects, which both Mark and I have undertaken right now, it's a more complex process. You have to hold on to the property for usually a minimum of 6 months before you can do the refinance, depending on what type of loan strategy you're using. Well, in those 6 months, as we've just seen, interest rates can double. And when your interest rate doubles from 3 or 4 to 6 or 7, well, that makes your cash flow a lot worse because your monthly payment's a lot higher. And then as interest rates are going up, well, that's going to make it harder for the home to get valued at what you would like it to get valued at. Maybe you've been planning on an increase in values like we had seen over the last 2 years, and you were hoping that another 10, 15% increase in appreciation was going to bail out something going wrong on your BRRRR project. Well, you might not get that. You might not get the 10 or 15% value appreciation that you were hoping for. So if I was going to give advice, it would be, if you're doing complex investment strategies like the BRRRR strategy and you're using debt to fund the project, estimate extremely conservatively. Yeah, this thing could, have an after repair value of maybe, as high as 150,000, 140 to 150. I would plan on 130 to run all your numbers at below, so that even if the worst case happens, you're still in the clear. That's my advice. Mark, anything else you got? That's all I have.
That all sounds good, Mike. I don't really think I have too much to add. I could always talk forever and ever on more topics, but we'll stop. But anyway, I appreciate you showing up on my channel again. I know you stay busy in your life, and it's always great that you can share a little bit of time with my channel too.
Yes, sir. Happy to do it.
All right, sounds good. All right, everyone. Well, thanks so much for watching. I know by now you know who Millennial Mike is, but if not, check out Millennial Mike's channel. And if you're still seeing this and listening, you know about my channel. So subscribe to both channels, like our videos, comment, share them, et cetera, et cetera, et cetera. So with that being said, thanks again, Mike. Thanks everyone for watching. Y'all take care. Stay safe in all you do. And we are signing.